Welcome to the Deep Dive. Today we're digging into the latest earnings call from the big player in agreement management.
Yep. We're looking at their Q3 results for fiscal 26, which ended back on October 31st.
And this one is a bit of a puzzle, isn't it?
It really is. Our mission today is to figure out the paradox here. You've got what looks like a classic beat and raise quarter. Great profits, great cash flow.
But the market hated it. The stock sold off pretty hard right after the call.
Exactly. So the question is, why did such a strong, profitable quarter get such a skeptical reaction from investors?
Okay, let's unpack that. We have to start with the snapshot, the headline numbers, because on paper, they looked great, especially on profit.
It absolutely did. I mean, the first thing that just jumps off the page is their operational excellence. That core profit metric, a non-GAAP diluted EPS.
Right.
It came in at $1.01. The consensus on the street was, 91 cents?
So a big beat, that's a 10% surprise to the upside.
A huge surprise. And the top line, the revenue, was solid too. Maybe not thrilling, but solid.
Total revenue was $818.4 million. That's up 8% year over year.
And subscription revenue was right in line with that, up 9%. So, a modest beat, but it's still a beat.
But the real story, the one management really wanted to talk about, was the CAF machine.
Oh, yeah. They basically called this one of their strongest profitability quarters in the last couple of years.
And they have the numbers to back that up. Non-GAAP operating margin hit 31.4%.
Which is just phenomenal for a software company of this size. It signals some serious discipline on their spending.
And that discipline, it turns directly into cash.
A ton of cash. Free cash flow, or FCF, grew 25% year over year, came in at $262.9 million.
Wow. So for every dollar of revenue, they're turning 32 cents into pure cash.
Exactly. And that cash generation is accelerating.
So what do you do with all that cash? You signal confidence. They bought back a record amount of their own stock.
A record $215.1 million worth. It's the biggest quarterly buyback they have ever done.
That's management screaming from the rooftops. We think our stock is cheap.
It's a very loud signal, yeah. But the market basically looked at that signal, heard it, and said, we don't believe you.
And that's where we have to dig in. We have to get beneath the beat.
Let's start with the story they're telling. The CEO's whole message is about this big transition.
Right. They're trying to change their whole identity, moving from just being the e-signature company everyone knows
to becoming this all-encompassing, AI-powered, intelligent agreement management platform, or IAM as they call it.
And that IAM platform is supposed to be the engine for all their future growth.
And to their credit, they have some real numbers to show it's working. The traction is there.
What did they say? Back in April, they had 10,000 customers on the platform.
10,000. And now, just 6 months later, that's exploded to over 25,000 customers. And they're saying IAM should be a low double-digit percentage of their recurring revenue by the end of this fiscal year. That's real momentum.
And it's not just more customers, it's bigger customers, right? The quality of the spend is going up.
That's a great point. They said the number of customers spending over $300,000 a year with them, that growth accelerated to 8%.
Which is the fastest they've grown that specific group in over 2 years.
Exactly. It suggests that their big enterprise sales pitch, getting huge companies to adopt the whole platform, is actually starting to work.
Okay, so that's the bull case. That's the optimistic story. Now let's look at the numbers that made investors nervous.
And it starts with billings. This is the metric investors watch like a hawk because it's supposed to predict future revenue.
Billings grew 10%. Which sounds pretty good.
It does. But, and this is a huge but, management gave a really important piece of context.
The footnote.
The footnote. They basically admitted that about half of that 10% outperformance was just due to timing. Early renewals, specifically.
Okay, let's pause on that because that's so important. What does pulling forward renewals actually mean for the underlying business?
It means the growth wasn't all from new demand. Half of it was, true growth new customers or current ones spending more right now.
But the other half?
The other half was just them getting customers who were going to renew in Q4 anyway to sign the check a little early in Q3.
So it's great for locking in the cash, but it doesn't really signal that demand is accelerating.
Precisely. You strip out that timing noise, and the real underlying growth rate for billings was closer to 8%, not 10.
So the core engine is still growing at that same high single-digit pace, which is the exact problem IAM is supposed to solve.
You got it. It just pours a little cold water on the whole acceleration narrative.
Yeah.
Now, on the plus side, consumption does look strong.
Dollar net retention, DNR, improved a bit, up to 102%.
Right, so their existing customers from a year ago are now spending 2% more. It shows the product is sticky.
And the actual usage supports that. Envelope utilization rates, so how often people are actually using the service hit multi-year highs.
And that's a really good leading indicator. When customers use up their existing capacity, it usually means they're going to need to buy more soon. So that's a point for the bulls.
But there is a cost to this whole transition, right? We saw it in the margins.
We did. Non-GAAP gross margin slipped a little bit, down 70 basis points to 81.8%. Management said that's mostly due to costs from their ongoing cloud migration.
So they're taking a short-term hit to build out that long-term IAM platform, which brings us to the AI story. If this stock is going to work, it's because of AI.
It has to be. The whole re-rating story is pinned on this intelligent agreement management vision being a total game changer.
So what's new on the product front?
Well, they launched something called Agreement Desk, which is like a central hub for managing contracts. And they have their first AI contract agents out in beta.
But the real advantage they keep talking about is their data moat.
And it's a massive proprietary moat. They're saying they have something like 150 million private consented agreements that they've ingested and structured.
And that's the data they use to train their AI models.
Exactly. And it's fundamentally different from a model trained on, publicly available contracts you find online.
What's the actual advantage they claim it gives them?
They estimate it gives them a 15, that's a 1.5, a 15 percentage point improvement in accuracy.
Which for legal and compliance work that's a world of difference.
It's a huge defensible edge if it's true. And they're building out credibility, too. They're integrating with all the big names. ChatGPT, Microsoft Copilot, Claude, Gemini.
And they got their government certifications, FedRAMP and GovRAMP.
Which just opens up the entire public sector market for them. So, again, it all sounds like a company that's executing really well on a tough strategic pivot.
So we come back to the main question. Why did the market flinch?
And the answer is in their forward guidance. And even more importantly, a huge change they're making to how they report their results.
Okay, let's get into that. Because this seems to be what really caused the concern. The CFO announced they're going to stop reporting quarterly billings.
They're just getting rid of it entirely, starting with a Q4 earnings call in March.
For an analyst who lives and dies by that number, that's like turning the lights off.
It's the nuclear option, really.
Yeah.
Instead, they're going to report annual recurring revenue, or AR, but only once a year. And then they'll report what percentage of that ARR is from IAM each quarter.
Management's argument is that this gives a better long-term view, that billings are too volatile. But come on, taking away a metric analysts understand, isn't that just hiding the ball?
That is exactly what the market is asking. Their defense is that billings are just too noisy quarter to quarter. And the other metric people might want, net new AR, is just too small right now.
How small?
Only about $60 million on average per quarter. So they argue reporting a number that small and that volatile would just confuse people more than it would help.
So they want everyone to look at the big picture, not the bumpy ride to get there.
Right. But the immediate picture, their Q4 guidance, did not help their case at all.
No, it implied a deceleration. They guided for Q4 revenue growth of 7% at the midpoint, down from the 8% they just posted.
And that's the red flag. Management blamed it on a tough comparison to a really strong quarter last year. But all the market hears is deceleration.
They did raise the full year guidance slightly, still in that 8% growth range, but it just wasn't the acceleration story investors were desperate to see.
Which brings us full circle. Strong profits, record buybacks, and a stock that gets punished. Let's just synthesize the top 3 reasons for that skepticism.
Okay, reason 1.
First is the growth plateau concern. Simply put, 8% revenue growth is not the mid-teens profitable growth they've promised investors. There is just not enough proof yet that IAM is actually reaccelerating the business.
Investors are saying, show me the money. Show me the IAM revenue that gets you past 8%.
Exactly. Second is the credibility rebuild factor. This strong Q3 comes right after a weak Q1 where they missed on billings and cut their outlook.
So they're in the penalty box. One good quarter doesn't get you out.
Not at all. Investors are in a trust but verify mode. And then the third reason,
let me guess.
Guidance. Guidance versus momentum. The Q4 deceleration combined with them yanking away the billings metric. It just failed to deliver that thrilling proof of a turnaround. The stock was already underperforming, and this report just didn't give anyone a reason to jump back in.
It really feels like we're all just in a holding pattern until that March earnings call now.
It's a high-stakes waiting game. Which, of course, brings us to our final segment.
My favorite, where we talk about a trade idea with our very important disclaimer.
This is not financial advice. We are not your financial advisors. Please do your own research.
But if we were in a hedge fund meeting right now pitching an idea, what's the outrageous but plausible trade based on all this?
The trade we'd pitch is to establish a long position using call options that expire shortly after that March Q4 earnings announcement.
So you're betting directly against this current pessimism, buying calls when everyone else is selling. Walk me through the catalyst.
Okay, so the stock price right now reflects maximum skepticism. The market is pricing this company as if it's stuck in this 8 to 10% growth range forever.
Right.
Management knows this, and they have made a very deliberate, very strategic choice to pivot everyone's attention to ARR as the superior metric. They've staked their credibility on it.
So that March call becomes everything. It's a binary event.
It absolutely is, because in March, for the very first time, they're going to disclose their full-year ARR growth guidance for fiscal 27. That's the moment of truth.
That's when they have to prove the IAM strategy is working.
If that initial FY27 guidance shows any kind of meaningful reacceleration back towards that mid-teens target they've been promising, or if the IAM as a percentage of ARR number is surprisingly high, that stock could have a massive one-day re-rating.
So you buy the cheap calls now while sentiment is terrible, and you're making a high-conviction bet that management will deliver the proof using the exact metric they just forced everyone to pay attention to.
It's a bet that their strategic pivot will finally line up with their new reporting. They took the risk of removing billings. Now they have to deliver a strong ARR forecast to justify it.
That wraps up our deep dive. The tension here is so clear. You have a company executing beautifully on profits and cash flow, but facing a market that is just refusing to believe in the growth story until it sees hard proof.
And that leaves you with the final thought to carry into that March earnings release. Management says this shift to ARR is about transparency and focusing on the long term. But will this new metric actually reduce the noise and align them with investors? Or will it just introduce new kinds of volatility and new ways for the market to be confused? That's the question that's going to decide if the stock finally breaks out.
Until next time, keep digging.